Hi, everyone, and welcome to the stream today. Welcome to session 2 in our discussion for the practice question masterclass that we are on. In the first episode, we looked at some key accounting standards from the ICAG past question, and today we're going to be doing the same thing to continue with the discussion. I see some of you guys joining. Welcome. Remember to share the video. Let us reach as many students as possible. So copy the link and share it in your WhatsApp group, in your Telegram platform, in your Facebook pages. Share it with your colleagues, those who are doing financial reporting, corporate reporting, studying accounting. Share the video with them. And let's reach as many students as possible. Also, remember, if you have not subscribed, make sure you subscribe to the channel as we keep on growing the community so we can reach many students just like you. Today, we're going to be continuing with the discussion, and we're going to be focusing on IAS 8, accounting policies, changes in accounting estimates and errors. Then we'll share some thoughts on IAS 20, government grants and disclosure, accounting for government grants and disclosure of government assistance. Then we'll come into IFRS 15, which is revenue from contract with customers. And we're going to be using questions to crystallize some of the principles in respect of these accounting standards. So stay tuned. It's going to be an interesting session today, and we're going to be getting into the discussion. If there are any questions you have, something you want me to share my thought on, you can put it in the comment section or the chat box. I want to hear from you, where you are watching from, and anything you have that you want to pick my brain on. Remember that our registration is still ongoing for the November 2025 examination. We are in session 4. You can get access to the lecture videos, get access to our summary videos, join our live sessions, and also study directly under my mentorship so we can prepare you better for the examination. So you can head on to our website, Nhyira Premium, or download the Nhyira Premium mobile application. You can also send us a message on WhatsApp, 050-114-9296. The number is scrolling below the screen, I think so, and you will be able to call us. So let me bring up my screen quickly. The ICAG has made some announcements for the examination. So I want us to start the discussion from that, walk you through the ICAG announcements quickly for the November 2025 examination as we go into the discussion. So this is an update that has been released by the ICAG. So registration for the examination is opening on Monday, which is 8th September, and it will be closing on Friday, 17th October. So that is the date for registration. So your portal is going to be open from Monday, 8th of September, and you are between 8th to 17th October, you will be able to register for the examination. The exam itself will be between 3rd November and 7th November. So that is the examination date. In other words, it's like the first week of November. That is where the exam is going to be. So from Monday, the registration for the exam is going to open. And as I say always, make sure you are only going to register for the papers that you have adequately prepared for. And so there is time, 17th October. So we still have some time to go. So you can take time, build momentum throughout this month, September. And, by 10th of October, by then you have made your decision. Then you can decide the subject that you want to write. But one thing you need to understand is this. If you are going to be sitting for the exam, then you want to register for the exams that you know you are going to have adequate time to study and put you in the position so you can pass the examination ultimately. I say this all the time. Don't just register for the exam because someone says, oh, I see it here. You have to keep writing. You have to keep writing. You have to keep writing. Yes, you have to keep writing, but you have to have a strategy to pass the examination. You cannot just be writing the exam over and over again just for the fun of it. So make sure you plan yourself out very well and structure yourself very well so you can register only for the papers that you think you can pass. And that will help you to study very well. So that is about the examination. As always, if you have one paper in level 2, you can add some papers in level 3 to sit for. right? So that's not a problem there. But if you have more than a paper in level 2, you cannot add any level 3 paper to write for the exam or to sit for the exam. However, although the deadline for the normal registration is 17th of October 2025, there is penalty option available. So late registration is available, and that is going to be only accepted a week after the deadline. So a week after the deadline, you can still register, but your registration will attract a penalty of 350 Ghana cedi. How much fees are you going to pay, or what will be the fee for the exam registration? There you have it. So it's an incremental charge. So depending on the number of papers you are writing and how much you are supposed to pay, right? And as I say always, based on your schedule, based on your time, probably you need to register for only 2 papers. But if you're going to write more than 2 papers, it means you're going to have the time available to study very well. So that is the fee structure there that you can take note of and then plan on it. Please note, if you are somebody who is coming new to the ICA and you have some exemptions, you can only register for the exam after the payment of all your exemptions. So just take note of that. That if you are coming in, you are now coming in with your first degree or your master's or whatever the heck that you are coming in, and there are subjects you have to write, the portal will only be open and you can only register after you have paid for all exemptions. So just take note of that as well. So that is your fee for the examination that you must be mindful of. Then another thing is also about deferment. So for some reason you register for the exam and you cannot write for the exam because maybe something comes up and then you have to travel or something. You cannot just sit for the exam any longer. So can you defer? Yes, but there is a condition. So it says deferment for any reason other than that stated under Regulation 22, Section 2 of the Institute of Chartered Accountants, Ghana 2023 LI 2476 shall only be accepted on or before Friday 17th October 2025, and it is done on the portal. A student whose application for deferment is approved can defer or postpone to the next examination only. Okay, so it means that your decision about deferment should come by the last date of registration for the exam. Because the date for registration for the exam, the deadline is the 17th of October 2025. So that is the idea about deferment as well. And if you defer, you can only apply it in the next examination date. So if you register and for some reason something comes up and you can't write in the November 2025, then your next option is to write in March 2026, and that is where this deferment will qualify you to do it. So just be mindful of that. So those are a few things you must understand. Date for registration for the exam, Monday 8th September to Friday 17th October 2025. Examination is going to be on Monday 3rd, or starting from Monday 3rd November and ending on Friday 7th of November. Then your fee and late registration requirements available there. Then certainly the last thing in respect of the deferment policy. Now note that for level 1 students, what will happen is that the exam will be conducted online, and so further guidelines for level 1 students will be coming up later on. And so, gradually ICAG is coming online, so you want to be mindful of that. Now, the timetable for the exam will be available later, or it's maybe accessible on the ICAG website. So these are some updates quickly from the ICAG that I want to bring to your attention before we get excited into the discussion today. Okay? Before we get excited into the discussion today. Okay. So now that we've gotten that out of the way, let's get excited into our discussion. Today we are looking at the question 2 from the July 2025 financial reporting examination. So ICAG, July 2025 financial reporting. Want to see if I can create a QR code for you here. So that is the QR code. You just turn on your camera, show it to it, and you'll be able to just download it. Or you can just download it on the ICAG website. So we are looking at the question 2 of July 2025 financial reporting examination. So let's go there. We're going to start from C, the C part of the question. Then we go to B. Then we go to the A part of the question here. So C says for 6 marks, it says, for each of the above changes, justify which one would be considered a change of accounting policy or a change in accounting estimate under IAS 8. So according to IAS 8, accounting policies, changes in accounting estimates and errors, we have changes in accounting policies, changes in accounting estimates. In a simple language, accounting estimates are amounts that are subject to the professional judgment of management. So they are subject to a lot of uncertainty. So usually estimates are always going to be subject to uncertainty and also will be then based on the professional judgment of management. So they are more discretionary issues. When there is a change in accounting estimate, it is applied prospectively. What does that mean? It means that change affects the financial statement for the current year and future financial statement. So a couple of things, and we're going to get into that in the context of this question. That is accounting estimate. Accounting policies are the basic concept, assumptions, principles, rules that are established and used in the preparation and presentation of financial statements. And so if there is a change in accounting policy, that is applied retrospectively. It means that it is going to be affecting the current year financial statement and the previous year financial statement or previous year's financial statement. Now, how far back we go when it comes to the adjustment in the retrospective application always depends on the judgment of management. So that is the difference between accounting policy and changes in accounting policy and its application, and accounting estimate and changes in accounting estimate and its application. So those are the principles that you must have. Once you know that is what the examiner is asking you about, before you then get excited into the question. So let's go then to the scenario. IAS 8 accounting policies, changes in accounting estimate and errors, draws a clear distinction between accounting policies and accounting estimates. Fire Limited made these changes during the year. So they made these changes during the year. Let's see the changes they made. Revision of the monetary amount of a provision for expected cost of a court case taken against the entity as a result of new information received. Revision of the monetary amount of a provision for expected cost of a court case taken against the entity as a result of new information received. Okay, that is more of something that is uncertainty based on measurement, amount measurement based on uncertainty. And so this is a change in accounting estimate. All right, because that's an estimate. That's an estimate because we owe someone and we had made a provision for it in accordance with IAS 37. Then a new information has been brought to our attention, and so we are revising that provision based on the new information. Okay, that's an estimate. So that is a change in accounting estimate. That's it. In this question, we are not asked how it should be treated because you have to be mindful of the context of the question. The question said, justify which one would be considered a change in accounting policy or a change in accounting estimate. So you're just stating it and going away. So this, the I is change in estimate, change in accounting estimate. II. Revision of the useful life used to depreciate plant and equipment from 6 years to 3 years. Okay. Change in the economic useful life of the asset is a change in accounting estimate. So that is also a change in estimate. Why? Because the same asset, one entity may depreciate it over 5 years, another entity may also depreciate it over 10 years. So it's discretionary and there is no specific rule in respect of it. So that is a change in accounting estimate. Then the last one is III. Change from cost model to revaluation model under IAS 16. Now, you have to know that the cost model and the revaluation model are established accounting rules, policies, or assumptions that must be used in the preparation and presentation of financial statement. So when an entity is changing from the cost model to the revaluation model or vice versa, then this one will be a change in accounting policy. So that will be a change in accounting policy. Because moving from the cost model to the revaluation model, or from revaluation model to now the cost model, is a change in accounting policy. That is the answer to the C part of the question. Very sweet, simple, straight to the point. That's all. We are done. Then we go to the B part of the question, which is taking us to IAS 20, accounting for government grant and disclosure of government assistance. So let's see what we have here. Requirement. I part of the question said, in accordance with IAS 20, government grant and disclosure of government assistance, explain how a repayment of a government grant should be accounted for in the financial statement. Stay with me carefully. Explain how a repayment of a government grant should be accounted for in the financial statement. Now, the accounting treatment of grant repayment depends on the method the entity used for the initial recognition of the grant. Stay with me. The accounting treatment of grant repayment depends on the method the entity used to initially recognize the government grant. What does that mean? You know from KG2 under IAS 20 that there are two ways grants can be accounted for. Either the grant will be accounted for as a deferred income, or the grant will be accounted for as a write-off against the asset. And so if, for instance, the entity is accounting for the grant as a deferred income, then any grant repayment will be written off against the carrying amount of the grants outstanding at the date of the repayment, so that any excess amount above what is outstanding in the deferred income account will be taken to the profit or loss account. That's the idea. And so under the deferred income approach, grant repayment, we will debit the deferred grant account, and then we'll credit our cash book for making the payment. If the grant repayment exceeds the carrying amount of the grant at the date that the payment becomes due, the balancing figure will be debited or written off in the profit or loss. However, where the entity use the second approach. In other words, write off the grant initially against the cost of the asset. Then on repayment, what is going to happen is that the amount of grant repayment will be added to the carrying amount of the asset at the date that the repayment becomes due. Then an accumulated depreciation will be calculated from the date of initial measurement up to the date that the grant became due for repayment on the grant repayment that has been added back to the carrying amount of the asset. And I'm going to show you this in a moment. But that is the answer to the I part of the question. Now, this is a fundamental calculation-related issue in government grants and accounting for government grants and disclosure of government assistance that the examiner is asking students here for 3 marks. But that is the answer to the question, that accounting for grant repayment depends on the method the entity used to initially recognize the grant. If the grant was recognized as a deferred income, then grant repayment is written off against the carrying amount of the grant deferred income. Any amount in excess will then be recognized in the P&L account. However, if it was the write-off approach the entity used, then the amount of grant repayment is added to the carrying amount of the asset at the date that the grant repayment became due. Then on that amount that has been added, depreciation has not been charged yet. So we charge accumulated depreciation from the date of the initial measurement up to the time that the grant repayment became due. That is the answer to the I part of the question, explaining how repayment of grant should be accounted for. Very easy, right? Very easy. Let's come to the II part, which is 5 marks, and possibly that is going to give us some goosebumps there. So II part for 5 marks. It says, for each method of presenting government grants in the financial statement, provide journal entries based on the above information. Okay. Remember, I just mentioned that there are 2 methods for accounting for the government grant. In the context of this question, the examiner is saying that for each of the 2 methods, provide a journal entry on how the above information will be presented in the financial statement. So let's go read the above information so we can understand what is happening there. So that is the B part of the question that we are looking at. Let's see what we have. Ghana aims to achieve its target of 10% of its total energy consumption coming from renewable sources by 2028. In line with this strategy to promote a sustainable and varied renewable energy industry, the government has recently extended subsidies to businesses that make solar farm investments. Motivated by this government assistance, Mitumi Limited or Mitumi Limited, whatever the heck, your employer has lately joined the solar energy industry. Okay, that's a beautiful story being, talked about. The last paragraph. In March 2024, Mitumi PLC installed and paid for 600,000 Ghana cedi of property, plant, and equipment on a farm. The PPE will be depreciated over 25 years. In July 2024, the government provided a grant of 40% to the company towards this PPE. The company's depreciation policy is to charge a full year depreciation in the year of purchase and none in the year of sale. So this is our story. And I need you to pay attention to a principle that I'm going to highlight on here. Because as I mentioned, it's not just about, the question we have before us and how you solve it. Because it is important you build the principles well to understand what is happening. If you check carefully, the entity's year ended for us will be, let me see, depreciated over 25 years. In July, they granted the government. Okay, we are not even giving any year ended for the company. But the most important thing is that full depreciation is charged in the year of purchase, which means in the year of purchase, normally we would have charged depreciation based on the number of months. So that if the asset had been used for just 3 months, we would do 9/12. But this rule means that even if the asset was used for 1 month during the year, we'll still charge full year depreciation. Then in the year that they sold the asset, no depreciation will be charged. So let's see what we have here with Me2Me Limited or Made to Me Limited, whatever approach you want to go, pronunciation you want to have. Is it PLC or limited? Yeah, it's PLC, like a listed company. So, the two approaches. Let's go to method 1. The method 1 is the easy peasy. So, we're going to write off the grant against the cost of the asset. So, write off grant against the cost of the asset. Okay, so let's see. We slash in our currency sign. So cost of PPE. The entity paid 600,000 cedis. Then we are told that the government gave 40% of that amount as grant. Please note that this question, government policy is already there. So what it means is that immediately you buy the asset, you qualify for it generically. So the policy is there. So it's not like the entity would have to buy and then have to wait. And so in that case, the date and timing might be different from when they bought the asset and when the grant was given. Because that rule is important. There is another question about government grants that we're going to be looking at, and you're going to see what I mean by that. So we less the government grant. We less government grant here. So let's see. 40% of this figure of 600,000. It's like I'm enjoying the zeros. 10 is 60, so 64 is 24. So that's going to be 240,000. And this becomes the initial cost of the asset. Or initial cost of the property, plant, and equipment. And that is going to give us 360, I guess. Yep. All right, 360,000. So under this approach, you permit me, let me finish the workflow, then we'll bring the journal entry. So we less the depreciation for the year. Remember they said it doesn't matter when the asset was bought, full depreciation is charged in the year of acquisition, none in the year of disposal. So we really don't care how long. So 360,000 divided by, what is the useful life? 25 years. See, I wanted to do times something. 360,000 divided by 25, and that is 14,400. So we take that out to get a carrying amount at the reporting date. So the carrying amount of the PPE minus 360,000 is 374,400. 374,400. So that is the accounting if we are using the write-off approach. But this is not what the examiner said you should do. Again, context of the question is key. The examiner said, for each method of presenting a government grant in financial statement, provide journal entries based on the information above. Okay, so that is where the answer comes in. So the initial recognition, the journal entry will be to debit maybe cash or bank if they receive the money. If it is not received yet, then it will go to grant receivables, okay? So we debit that with a grant amount of 240,000. Then you are crediting PPE. So property, plant, and equipment, because as we mentioned, this is the write-off approach. So let's see, 240,000. So that's the journal entry for the initial measurement. There. Then the subsequent measurement, journal entry, the depreciation charged for the year will go to profit or loss. So we pass the journal entry for that. So this is with the grant. So here you will debit profit or loss with the amount of depreciation for the year, 14,400. And then you credit property, plant, and equipment. With the same figure, 14,400. This is the answer to the method number 1. This is the answer to method number 1. If we use the write-off approach, the journal entry that we have to pass. Let's look at the second method for us. With the second method, we are going to use the deferred income approach, which sometimes is referred to as the default method. So method number 2, deferred income approach, which means that we are recognizing the grant. That's the second method. So grant is recognized. So if we are recognizing the grant, then what happens here is that the journal entry on the recognition of the grant will be to debit cash or bank with a grant amount 240,000. Remember that. But we will now credit government grant for us. So we could call it deferred income. Okay, government grant, 240. So that is the grant amount. So on subsequent measurement, we depreciate the plant at the initial cost of 600,000. So PPE is depreciated at the cost of 600,000 over the 25 years. And that will be recognized in the profit or loss. So depreciation in this case will be 600,000 divided by 25 years. Want to confirm? Yeah. Again, full year depreciation is charged in the date of acquisition. So we don't care when the actual acquisition was done. 600,000 divided by 25, and that's 24,000. All right. So we pass the journal entry for the depreciation, which you know already here. Permit me to just copy it from here. There we go. But this time around, it's going to be the figure we had, 24,000. Remember, this is a 5-mark question, so you are doing this in 9 minutes. So speed and accuracy, it's going to be very important. So this is the depreciation for the year for us. Okay. Then we need to amortize the government grant over the useful life of the asset. So we charge that to P&L. So government grant, which will go like other income to P&L, will be the grant we are receiving, 240,000, divided by 25,000. Divided by 25 years. So 240,000 divided by 25, and that is 9,600. This is an income. And so double entry will be to debit the government grant. Sorry, you debit, yes, government grant or deferred income with a 9,600. And this is an income, so we credit profit or loss. Usually it could be under other income in the profit or loss, 9,600. This is the journal entry for this question. And we are done. So for 5 marks, 9 minutes, you are using the 2 methods. Method number 1, the right of approach. Method number 2, the deferred income approach. But let me touch on this quickly, although not specifically in this question. In government grants, when we are using the deferred income, at the end of the year, it is important that we always split the grant into current liabilities and non-current liability. So let me illustrate that to you quickly. So the carrying amount of the grant at the end of, say, the first year will be the grant we got, 240,000, minus the amount we charged for the year, which we said we would debit it, the 9,600. So that the carrying amount becomes 230,400. Now, this carrying amount, yes, it's a liability because deferred income is a liability. Must be recognized in the statement of financial position. However, you don't just take it and go and put it under non-current liability or put it under current liability. So this 230,400, we must split it between current liability. So a portion must go to current liability. Then the remaining amount will go under non-current liability. Will go under non-current liability. Now, the way it works simply, what is a current liability? Or what items come under current liabilities. Current liability relates to the items that are due to be paid within 1 year. Okay? So what is the grant that we will charge for the next accounting year? Certainly, every year we are charging 9,600. So under current liability, we'll have deferred income in respect of government grant, 9,600. So that the balancing figure will be the non-current liability. So the balancing figure from the carrying amount, which is 220,800, is what will go under non-current liability. Again, it is not required in this question, but because I'm in class and so I need to explain that to you pretty well there. So that is the idea about government grant and accounting for government grants. So always note that if you are using the deferred income approach, the current amount of the government grant must be splitted between current liabilities and non-current. The amount that goes to current is the amount that is chargeable within 12 months, so that the excess amount will be taken to the non-current liability. This is why the I aspect of the question, for instance, it says, how should you account for grant repayment? And we explain that if this grant becomes due or something happens and the government says, hey, you deceived us, so pay back some of the grants or even all the grants, we will just write it off against the carrying amount of the grant. So that if the amount we are paying exceeds the carrying amount, the difference goes to the P&L. But if the amount we are paying is below the carrying amount of the grant, then the excess carrying amount of the grant will now be amortized over the remaining useful life of the asset. That's the idea about accounting for the repayment of government grant. But in the case of the first one, the right of approach, if the grant repayment becomes due, you can't write it off against anything. So the amount of grant repayment, you have to add it back to the carrying amount of the asset, and you hadn't charged depreciation on that figure because you subtracted the grant from the beginning. So now that you are adding back the grant which you subtracted from the beginning, it means you have to charge depreciation on it. So you're going to charge accumulated depreciation from the date of acquisition to the date that the grant repayment became due. This is the answer to the B aspect of the question. IAS 20, accounting for government grants and disclosure of government assistance. That is the idea about that. Very sweet, simple, straight to the point. So slide 1 there for the method 1 for us. And then the slide 2 for the second method. Again, in the context of this question, we are passing journal entries. So you must know what is supposed to be debited, what is supposed to be credited. If your journal entry is weak, then you toast it. Then certainly the grants carrying amount being splitted into current and non-current, and what has to be done there. So that is the idea about that, and that is what we must understand. Let's look at the A aspect of the question now, which is IFRS 15, revenue from contract with customers. IFRS 15, revenue from contract with customers. This one is 6 marks, so we are supposed to use 11 minutes around that time, 10.8, so 11 minutes. In line with IFRS 15, revenue from contract with customers, demonstrate how Somwabi Limited should account for its revenue in the period from January 2024 to June 2024, and in the period from 1st July 2024 and 31st December 2024. This is an interesting one, right? So IFRS 15, revenue from contract with customers. The deal is that we recognize revenue when performance obligation is what? Satisfied. The 5-step framework for revenue recognition, you've heard me say this, can be asked as a theory question, and you must understand. Again, you are seeing something that in the question 2 standard related question, there are theories about standards that the examiner is asking you. And these theories are exclusive of the dedicated 20 marks theory that you are going to be having in the exam hall in question 5. So question 5 is purely theory, 20 marks. But in addition to that, the question 2, the standards areas or the standard area, is also having some written questions in there. And that is really important. So let's go. Somwabi Limited. Let's see what we have for Somwabi Limited. Let's read. Somwabi Limited has a contract to sell its products to customers for 200 Ghana cedi per unit during the 2024 financial year. Stay with me carefully. During the 2024 financial year. The price would drop to 150 Ghana cedi per unit if the customer bought more than 1,200 units a year. Get a story. So normally our price is 200 Ghana cedi per unit. But should any customer say, hey, I will buy more than 1,200 or is buying 1,200 or more, then the price will now be 150 Ghana cedi per unit. Let's go. Based on their prior trading history, Somwabi Limited did not anticipate that the customer would buy more than 1,002 on the day the contract was initiated. What does that mean? It means that this particular customer, the entity is assuming that they will not buy above 1,002. That means if they are buying anything, we will sell it to them at 200 Ghana cedi per unit. That's the assumption when the contract was signed. Let's look at what happened in the final paragraph. However, on October 2024, Somwabi Limited formed the opinion that the customer would meet or exceed 1,200 units. Threshold based on its sales of 1,100 units by that date. Okay. The customer had purchased 500 units on that date and informed management of Somwabi Limited that it will be placing a further order of 200 units on 1st December 2024. So what's going on here? Which is a question you must understand. So that from the second part of the year, which is from July to December, now we have formed an opinion that, this customer will exceed the threshold of 1,002. So it means anything bought within the July to December will be at the reduced price of 150 Ghana cedi per unit. But anything bought prior to that may be at the 200, subject to the fact that now that we have formed an opinion, it means even if the person had bought something before that time, we must now give the person a reduced price. See the way it plays out. This customer had purchased 600 units at 30th June 2024. So pay attention, let's see how we come. So from 1st January 2024 to 30th June 2024, at 30th June 2024, the customer had bought only 600 units. And since the entity had also anticipated that the customer will not buy more than 1,002 based on their history, it means The 600 units bought by 30th June 2024 will be priced at the 200,000 per unit. Okay, so revenue will be the 600 units. Is it 600? Yeah. Multiplied by the standard selling price of 200 per unit. So that's going to give us 600, 200, and that's 120,000 Ghana cedi. 120,000 Ghana cedi. Stay with me. Now, the journal entry for this, if we want to pass a journal entry, will be to debit trade receivables, all right, and then credit with a 120,000. It's like I'm enjoying the zeros, and then credit revenue. Same 120,000. So for the period of 1st January 2024 to 30th June 2024, we had not concluded that the customer will exceed, so the standard price will apply. Now, from 1st July, or between 1st July 2024 and 31st December 2024, the story is changing. Look at it. It says that the customer had purchased 500 units on that date. So this is on 1st October. The customer bought 500 units. Now, it was at that period that we concluded that, oh, the customer will meet the 1,200 threshold. So it means now we have to price the customer on the 150, not the 200. On the 150, not the 200. So what is going to happen is that the inventory purchased on 1st October, so 1/10/2024, the revenue from that will be 500 multiplied by what? The 150 units. Sorry, 150 Ghana cedis. Because we will now use the reduced price as they have met the demand. And that's 75,000. Again, journal entry for that will be the same as this. Let me copy this and bring it down. Didn't copy everything. So revenue. This time around, 75,000. 75,000. Now, stay with me carefully. Then we are told that the customer informed management of Samwabi Limited that it would be placing a further order of 200 units on 1st December 2021. So that 200 units also that was bought on 1st December 2021 will also be priced at 150. So 1st December 2024, revenue will be the 200 that they bought, because remember we are working for 31st December. So by 31st December, the 1st December sales of 200 has been bought. So 200 times also 150. And that gives us 30,000 Ghana cedi. And so the journal entry for that will be same idea. 30,000. 30,000. But here's the catch. Here's the catch. If now the customer has met the threshold, then it means the goods the customer bought by 30th June, 600 units, which we had used the standard price of 200, should also be priced at the 150. Because the contract says if the whole year the customer can buy 1,002 or more, then the selling price will be 150 per unit. So by 30th June, the customer had bought only 600 units. Now by the end of the year, the customer had exceeded the threshold. So it means we had overstated the revenue amount and the trade receivable amount by an extra 50 cedis. So we need to now recalculate that revenue, and that reduction reverse it in the receivables and revenue. Okay, so recalculation of the units sold to 30th June 2024. So now it has to be, so revised revenue will be 600 units by 150 Ghana City. Sounds good? 150 Ghana City. And so we multiply that up, 600 by 150, and that is 90,000. So it should have been 90,000, but we charged 120. So we are going to be having an excess price coming up. Give me a sec. Yep. So reduction in revenue based on the contract is now going to be 120,000 minus 90,000. And that is 30,000. And so this will be reversed by, now we debit revenue, meaning deduct that from the revenue, 30,000, and deduct it from the money the person owes us, which is the trade receivables. Also 30,000. This is the answer to the question. All right? And you are doing this in 11 minutes. Speed and accuracy, understanding of the principles, and how to structure your solution. That is the idea about the question. So get a premise well. By June, the customer wasn't expected to meet the threshold. So the June sales was priced at the standard price of 200,000. But by October, now the customer has met the condition. So anything we sold during that period will be at the reduced price of 150. Now, since the customer has now met the period, then it means the earlier sales that we priced at the standard of 200 is overstated. Hence, has to be revised downward. And that revision will be subtracted from revenue and subtracted from trade receivables. These are the things you must understand in respect of this question as well. And this is the ICAG July 2025 Financial Reporting Question 2, focusing on IFRS 15, revenue from contract with customers, IAS 20, accounting for government grants and disclosure of government assistance, and IAS 8, accounting policies, changes in accounting estimates and errors. The key thing that I mentioned is that in the standard related question, the question 2 area, we are seeing written questions coming up. We are seeing comment questions coming up. And so when you are learning the standards, don't just be fixated on the calculation part of the standards. Look at the theory issues as well. In addition to that, even the calculation part of the standards can be asked as a written question, especially what you saw here under the BI, where it says, explain how grant repayment should be accounted for. And you have to explain that. If it was a calculation, maybe you would have done it easily. But now that same calculation, the examiner says, put it into writing for me. And these are the things that you must understand when we talk about these questions. And that is where we are going to be ending the discussion today. Thanks very much for joining the stream. Again, if you want access to any of our materials, books, joining our lectures, you can send us a message on WhatsApp or head on to our website. Our enrollment is still ongoing, so you can enroll, register, get access to all our full lecture videos, as well as our summary videos, join in our live sessions, and be mentored, be guided, be assisted, so the principles will become very easy for you, so you can go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So we're going to be meeting Friday, 4:30 p.m. or 16:30 GMT, and we are going to be continuing the discussion in respect of the IFRS masterclass using questions to crystallize the principles. Take care, and I'll see you on Friday.